Hey everybody, it's Justin here, America's Honest Tax Accountant with Number Crunch Nerds. Welcome to part 4 of my 2024 tax filing season video series for small businesses and individuals. Let's pick up where we left off in part 3. So we were right here. We had just determined the amount of depreciation on the new property that we placed in service in 2023. Remember, we're doing 2023 tax returns right now, due April 15th, 2024. And we determined that the amount of depreciation after we made all of those adjustments to increase and decrease basis was $419,440 over the next 27 and a half years. And one thing I want to show you in here before we continue entering the rest of the rental property data is I want to show you there's a nice depreciation report. Let me expand this to make it full screen. Okay, so then I'm going to go right over here to this depreciation report, page 1. Click on that, and it's going to show us a report that will tell you what your depreciation is going to be not only this year, but what your accumulated depreciation is. Accumulated depreciation means each year you have depreciation and it gets added up year after year after year, so it accumulates basically. So you add this year's, next year's, and so on all the way for 27 and a half years, and it will accumulate to the total depreciable basis, assuming that you hold the property for the full 27 and a half years. If you don't hold it for that long, if you sell it at some point previous to the 27 and a half year mark, then the total accumulated amount will not reach this total. So right here, prior year depreciation right here. In fact, let's just go through the whole thing. So here's the property. Here's the date placed in service. Here is the cost that we figured out net of the land. Here is the amount of land plus those extra expenses that were allocated specifically to the land in the last video. We have 100% business use. Now this says 100% because in previous portions of this video series, when we first started entering information about this property, we said on one of those screens that it was 100% business use, and that's why it says right here. Now, we didn't take any 179 on this property. Residential property is not eligible for that, but this depreciation report will encompass all assets. So if you did have assets on this report that were eligible for 179 and you took 179, that would show up right here. Special depreciation allowance means bonus depreciation. In 2023, bonus depreciation, again, residential property is not eligible for that. But on other kinds of property, bonus depreciation is 80% of the eligible cost in 2023. And you can take both Section 179 and bonus on assets that are eligible for these things. This will be something for another video, or perhaps we'll put some new assets in place in our rental property, and then we'll come back here and you'll see not only will the asset be listed here, but we can take some of these special depreciation allowances. So right now for this property, we have, here's our depreciable basis, here's our life, here's the method or convention, which will vary depending on what the asset is. And this means straight line method, and this is using the mid-month convention. You don't really need to pay too much attention to what that means. That's kind of a really technical thing, which you could Google that if you're interested in what those specifically mean. But here's the real key. Here's the current depreciation. So this is what's going to show up on Schedule E. It's going to show up there automatically. TurboTax will just put this number on Schedule E for you. And then next year, so you can imagine, when you see this form and it says 2024 on it, what's going to be right here in this box for prior year depreciation? Well, it'll be this number. This number for 2023 will go over here, and there'll be a new number for 2024, which probably it'll generally be the same number every year. It may vary because this is only a portion of the year, the first year, but in the second year it'll be the full year. So this number is probably going to be a little bit larger in 2024. But the 10804 will be here, and then in 2025 it'll be the 10804 plus the number that was here for 2024. That'll be added in here, and it'll be accumulated. right here. So this prior year depreciation means accumulated depreciation. So you have this nice little report that can tell you exactly the amount of depreciation you're taking in the current year plus all the accumulated depreciation you have taken to date since you put the property into service. All right, so let's go back to the step-by-step view. Okay, here's where we left off before. Let's hit continue and see what is coming up next for this property. So this is what we got. The property profile, we handled that in the previous videos. The next thing we're going to do is rental income and then rental expenses. Here's our depreciation, and that's going to be automatically calculated, and that will transfer over to Schedule E. In fact, if we go over to Schedule E, okay, so I went back to Forms View. Here's Schedule E right here. We're going to scroll down, and the depreciation probably is going to be there already. There it is. So there's the 10,804. So we're going to go back. We're going to fill in all of these other income and expense items, and then we're going to come back here to the form to make sure that everything is showing up. So let's go back to step by step. Okay, so we're back here. The next thing we're going to do is rental income, and it mentions that you can get rental income reported to you on a 1099 miscellaneous or a 1099K. Now, if you are renting to an individual, chances are you're not going to get either of these forms. If you're renting to a business, you might get a 1099 miscellaneous. And if you'll recall what that looks like, here's the 1099 miscellaneous right here, and the box 1 is the rents. So if you're renting to a business, it's possible they will file one of these forms and give you a copy reporting to the IRS how much rent they paid you during the year. And so there would be a number right here for the amount of rent received. Now, 1099K, that has to do with third-party payment processors. And so if you are collecting rent and that your tenant is paying you like by credit card or PayPal or some kind of third-party payment processor, it is possible that you will have rental income reported to you on here. What you want to make sure to do is you want to make sure you're not double counting. We went through this extensively in video number 1 of this series. I also have a video specific to the 1099 miscellaneous. So if you want to know more about 1099K, 1099 miscellaneous, just search on YouTube Number Crunch Nerds 1099 miscellaneous, or for 1099K, go watch video 1 of this series, which talks extensively about making sure that you're not double counting income of any kind, including rent. Now, in this case, what I have, I'm going to assume for this example that we're just renting to an individual. So this property, let's say it's a residential property. The individual paid rent to us of $20,000 during the year. And this is my tax return supporting work paper. I have the name of my property. I have all my income and expense information. And what we're going to do, right now you can see I only have one property visible. But if you have multiple properties, I'm just going to expand this for a minute. Right, we can start just expanding this out. There'll be a column for each property that you have, and you can make as many as you need for as many properties as you have. And this is how you create your audit support documentation or your tax return supporting work papers, because in the event of an audit, you want to have all your ducks in a row. And that's how we get everything organized, is we have to put it into a central location. And I'm going to go into some more details about how we can get all this stuff organized and summarized in a little bit. But for right now, let me minimize that. We're just going to work on one property, and it's going to be this 1234 West Street. So let's start with rental income. There's another little information tab here. Let's just run through this real quick and make sure that there's any special cases in here we want to talk about. So advanced rent is considered income when you receive it. So you are a cash basis taxpayer is what it's called, most likely. The only other option is that you could be like an accrual basis taxpayer. That's not going to apply to most people. Now, if you are a business and you are collecting rent, you are holding this property in a business, it's possible you could be an accrual basis taxpayer. But if you're just an individual filing a 1040 with a Schedule E on it, you're a cash basis taxpayer in almost 99.9% of cases. So for a this statement right here is specific to a cash basis taxpayer who's filing a Schedule E. So, for example, if you accept new tenants and they pay you the first and the last month's rent, the last month's rent will be used, if it'll be used for the final month, they occupy the property, etc. The last month's rent is considered advance rent. It's taxable when received because you're a cash basis taxpayer, which means you get taxed when you receive cash, even though it's not actually, that payment isn't really for anything until the last month, which is like 12 months away typically. It's still taxable when you get it if you're a cash basis taxpayer. Security deposit, right here it says it's considered advance rent if it is to be used for the final payment of rent. So if the security deposit turns into the final payment and you receive it up front and you're a cash basis taxpayer, which you are, then that's going to be taxable when you get it. So, if you get it in 2023, even though the 12th month of rent isn't until 2024, you're still going to report that as rental income in 2023. However, it says if it is to be returned to the renter at the end of the lease, if it is considered to be refundable, it is considered to be refundable and is not income. So if the security deposit does not turn into the last month's rent, and that'll be based on your lease terms, your lease contract, then you would not pick that up as income if the arrangement is that you will return it to the tenant. However, if they forfeit some of the security deposit for whatever reason, that probably won't happen until 2024. When they forfeit it, it will become income at that time, which generally, in that example I just gave you is 2024. Okay, so security deposit, you have to look at the terms. If it's intended to turn into the last month of rent, it's income now in 2023. If it intended to give it back, it's not income at all. But if they sacrifice some of it or forfeit some of it for whatever reason, it'll become income in whatever year that occurs. Okay. These two here I'm not going to spend much time on. Tenant pays expenses for you. Tenant provides services. If you read these, you'll see that these are just like kind of a wash. Like basically, let's say the tenant pays $2,000 for something or provides services worth $2,000. You'd pick up that $2,000 as rental income, and then you subtract $2,000 of expenses, and it would end up being zero or a wash. So you can read these, but that's not anything I'm going to spend any more time on. Lease with option to buy. If the rental agreement gives the tenant the right to buy your rental property, payments you receive under the agreement are rental income until the tenant exercises his option to buy. Unless the rental payments are applied toward the purchase price, payments made before the option is exercised remain rental income. So basically, if you have this situation where in your arrangement there's an option to buy the property, if the lease payments are not applied towards the purchase price, then it's just rent, and you would pick it up as rent just like you normally would. And then when the tenant exercises the option to buy, then it would become a sale. Now, the opposite of that is if the lease payments are actually applied to the sales price, then it's not rent anymore. Then what you have is called an installment sale, and that's not covered here in this little blurb. That's kind of a whole topic for a video in and of itself. If you have an arrangement where the payments that you're getting, which are rent, quote unquote, but actually those payments get applied toward the purchase price, what you have is an installment sale. And if you have that situation, I would Google installment sale on rental property, and I would try to get some information about what you have to do in that situation. That's a good topic to make another video about, but that's not something we're going to cover right now. Just be aware that in that situation you have an installment sale. So let's close that and let's get started entering our rental income. Okay, here's the rental income screen. We have our entry area for the 1099 miscellaneous, 1099K. We're not going to deal with those right now. Other income, so basically everything else is going to go in here. Now we have $20,000 here, and I'm going to have a refund. Let's say there was a $150 refund for something, an adjustment of some kind. I don't think there's actually a place to put this, so I'm going to do our net rent received right here of $19,850 in this example. Hit continue. And that's basically it on that. Rental income entry is pretty straightforward. So there's our $19,850. Now let's go to expenses. So I have all my expenses for the year listed right here. I'm going to click that. I'm going to choose what I want to work on. And what I'm going to do is just pause the video. I'm going to type all of these in and then I'll be right back. Okay, so I have our advertising, cleaning and maintenance, insurance, professional fees, supplies, real estate taxes. That covered everything right here except for mortgage interest. So it looks like mortgage interest is going to be on the next screen or on a future screen. So let's keep going. Okay, here it is. Report your mortgage interest. So I'm going to put in a lender name and I'm going to put in our $2,543 of mortgage interest right here. Let's see what other information we have on the screen. Enter all mortgage interest reported to you on Forms 1098. So you will receive a 1098 from your lender. Should have this number on it right here, or whatever your number is. If you refinanced and paid points, you enter your points in another area of TurboTax. Let's see what we got here. Loan origination fees, maximum load charges, loan discount points, I believe, let's see, charges paid by the borrower to get a mortgage for a rental must be amortized over the life of the loan. So amortization is kind of like depreciation. It basically means the same thing. It's just a word used with financial instruments as opposed to physical property. They say depreciation for physical property like the home itself or furniture and fixtures, whereas amortization has to do with like financial instruments. Where do I enter my points? Points are entered in the same area of the interview where you track depreciation on your rental property or rental furnishings. You need to go to the asset depreciation topic and enter your loan fees. They are categorized by the IRS as amortizable intangible. You will enter Code Section 163 loan fees. This is something that we can do when we're done in this section. I'll actually throw in some points or fees into our list of things that we paid so we can go see how to set this up right here and also how it will show up on that same depreciation schedule that we looked at earlier in the video. So we'll come back and do that a little bit later. I paid more mortgage interest than is shown on my Form 1098. I looked at this example a little bit earlier. Basically, it's like if you paid some mortgage interest, as part of the escrow period, or it didn't show up on your 1098 or something like that, you should report all of the mortgage interest that you paid. If you paid more than shows up on your 1098, you should report that. And if you click this box right here and you hit done, right here it's going to ask you to put in a description as to what is the reason why you paid more than what's on the 1098. I would just put in something brief that explains the situation. I also paid mortgage insurance on my Form 1098. Let's see what that one is about. All right, qualified mortgage insurance premiums are those paid in 2023 for mortgage insurance in connection with a mortgage you use to purchase a piece of property. And it has to be property purchased after December 31st, 2026. And it has to be in one of these forms. So it's either mortgage insurance provided by the VA, the FHA, the Rural Housing Administration, or private mortgage insurance. I would expect that if you're paying that, it's going to show up on your 1098. Let's take a look at a 1098 and see. So here is a 1098. This is what you will receive from your lender. The mortgage interest you pay, which we already entered into TurboTax, would be right here in box 1. Mortgage insurance premiums will be right here in box 5. So if you're paying them, you're going to see a number here. If you believe you're paying them and you don't see a number here, then you should investigate further to find out if you are actually paying them, or if you are paying them, if they qualify as one of these types of mortgage insurance so that you can put it on as a deduction on your Schedule E. So assuming you have that, we're going to click this box. There's a place to put it. I'm just going to throw in $1,500 here. And what that's going to do is that's going to get added to my other insurance. Like I have, as an owner of a rental property, I have insurance on the property, which I have here is $1,000. This is going to throw another $1,500 in. So let's change this from $1,000 to $2,500. So it's my original $1,000 plus 1,500. And just for simplicity here, I'm just going to put a plus private mortgage insurance right there so we know what this 2,500 consists of. And I'm going to say done right here. Any other interest paid, interest not reported on a 1098, interest reported on 1098s that do not list your name and social security number. That's probably not very common. I'm going to just say no. We don't have any of that. Let's keep going here. Did you refinance? Let's just say no for this example, that we did not refinance, because in this example we just purchased this home this year. So the likelihood of refinancing for this example is low. Any miscellaneous expenses. So right now I have entered everything shown right here all the way up to my grand total for this particular property. Mileage deduction for miles that you put on a personal use vehicle for purposes of doing things related to your rental property. That's going to get entered somewhere else. That's not going to get entered here. So right now I have entered all of this down to the 10,593. The only thing missing is the mileage, so I'm going to just say no for that. But if you do have something that that wasn't on the previous screen, you can throw it in here. All right, I'm going to hit continue, and that's everything so far. So let's see what we got. Here's the 10,593. That's this number, so that's all my expenses. There's the 19,850, so that is my net rents received right there. That's the depreciation schedule right there. And this, remember I said this is the screen where we were going to have to throw in some fees paid to get the mortgage would have to be amortized over the life of the loan. We'll do that in the next video. We will update this right here for those types of fees that need to be amortized. And then vehicle expenses, let's skip this one for right now. Let's just end this video by doing the vehicle expenses. I'm going to start that one real quick. Any vehicle expenses, you can use the standard mileage rate or actual vehicle expenses, but not both. If you're not using your vehicle significantly for purposes of your business, a lot of people find that the standard mileage rate is better for them. Right now for 2023, it's 65.5 cents right here for each business mile, basically. And you need to keep a mileage log. You are supposed to keep a mileage log for documentation purposes. In case you come under audit, the IRS is going to want to see some kind of mileage log or mileage tracker. And I actually have one in here, which let's just go over this real quick right now. So here's a mileage log, a basic one that we're going to include with our work papers. So here it is right here, mileage log, tax return supporting work papers, tax year 2023. So for example, show property to prospective tenants, 26 miles. Pick up supplies at Home Depot, 45 miles. Let's say you live out of town, the Home Depot's far away, or you get a lot of round trip driving to do. You may be out driving all day. 26 miles to a sink repair. I've set this up assuming that where your personal residence is about 26 miles away from the rental property. So each time you do something, it's like 26 miles. Meet with the HOA, show the landscaper the property, etc., etc. This is how you set up a mileage log like this. So total mileage right here is 149 miles. And there's our rate. There's our mileage deduction rate of 0.655, giving us a mileage deduction of $98. So I have it calculated on here, and that's what actually comes over to our tax return supporting work paper right there as an additional deduction. So it's going to be this number minus the sum of, it's going to be the net rent received minus the sum of these two, which is all of our other expenses, and our mileage deduction should give us our net rental income or loss on Schedule E. So the only thing we have to do is we have to get this 98 in there. And if I believe it's probably going to ask for like the total mileage, it's going to do the calculation itself, TurboTax. It's not going to want you to do it. So 149 is going to be our mileage for this example. So let me minimize that. Let's go back here. Let's just say, yes, we have vehicle mileage or expenses related to our rental property. I'm going to go in here. Let me just enter some basic info. Okay, so I threw in Honda Accord because that was their example right here. Auto under 6,000 pounds, that's what that is. We started using it on the same day we purchased the property. So let's say April 1st, 2023. I stopped using this vehicle in 2023. I'm just going to say no to that. Let's continue. Do you own this vehicle? For this example, I'm just going to say yes, we own this vehicle. Yes, this vehicle was available for personal use. That's most likely going to be the case unless you're using your vehicle 100% for business, which for most people, that is not going to be the case. Most people are using a personal vehicle sometimes for business purposes, and that's why you have to track your business miles. Did you have another vehicle available for personal use? I'm going to say yes, because that's generally what people have. Let's get some info about how you tracked your rental property and personal miles in 2023. Here's the question right here. Tracking includes a mileage log, which I just showed you right over here. This is an example of a mileage log. A spreadsheet, which is what this is. A tracking app on your phone, which you can download and track business miles that way, or something similar. All of these are acceptable types of documentation for the IRS. As long as you have something documented showing your mileage for business purposes, in general, that will be accepted as appropriate documentation. Did you document the miles you drove for this rental property? Yes, I did. Did you track the miles you drove for personal stuff? I'm going to say no, because nobody does that. All right, let's click continue. All right, I'll enter the total miles I drove for the period I used my vehicle for business. Total miles driven for all purposes. Miles driven for rent or royalty. So rental or royalty. So that's our 149, which I had right down here at the bottom. So in this example, 149 was not for all purposes, for rental right here. And they want to know total miles driven for all purposes. So if you, as part of this, and you know what, I don't have this on here yet, but as part of this tracker, what you want to do is you want to basically have an odometer reading on the first day of the year, or in this case, you would have your odometer reading on the first day we started this rental property. And as I'm saying that, I just noticed that these dates really should start on 4/1, right? Because that's when we started this rental property. So just pretend these dates start on 4/1. That would be most appropriate for this example. But what we really should have, in addition to this on our mileage log, is we should basically have an odometer reading on 4/1, like the day we started using the personal vehicle for business purposes. And then we should have an odometer reading on the last day of the year. So you got to basically take 2 odometer readings each year when you're using your personal vehicle for business purposes. So let's just say that we had 12,000 miles was what our odometer readings showed in this particular example. Commuting miles, I'm not even going to bother tracking that. Nobody tracks that. So I'll enter the beginning and ending odometer readings. So you could do that as well. You could enter that. However, I think it took it away. It took away the 12,000 I put in. I'm just going to stick with this. Let's just say that we have an odometer reading. It shows we drove 12,000 miles between April 1st, 2023, when we purchased the property, and the end of the year. We had 149 miles in this example for business. I'm going to click continue. Most people, it's going to be 0 to 4 vehicles here. If you have 5 or more vehicles being used for a rental property, there will be other rules that you have to follow. But for most people, it's going to be 0 to 4 vehicles. All right, and you got the standard mileage deduction of 98, which is what we had calculated already right down here. And so this 98 is going to show up on Schedule E as well. So now what we want to do is we want to go to Schedule E, and we want to make sure that what we have there at the moment is $9,159 as our net rental income. And if we do, then we have entered all of this information appropriately. And let's see, what is this right here? Oh, do you want to try to enter your actual expenses and maybe you get a bigger deduction? If you enter your actual vehicle expenses, what's going to happen is it's going to still use your business mileage to calculate a ratio. of basically your business mileage over your total mileage. So in that case, it would be the 149 miles divided by 12,000 miles for the year. And they would multiply, which is a very small ratio, and they would multiply that by all of your actual expenses. So you'd get like a little tiny bit, a little bit of your oil change, a little bit of your tires, a little bit of your maintenance, a little bit of whatever, your actual vehicle expenses. And that's how much would be given as a deduction on Schedule E for this rental property. You could certainly do that. For this example, I'm going to stick with the standard mileage deduction. A lot of people don't like to keep track of all of this. It's kind of like a lot of work to gather up all this information, and the difference between these two deductions may not be enough to make it worth your time. But if you have a lot of expenses related to a vehicle, you certainly could click yes and enter the actual expenses. Make sure you have receipts and documentation, and I would even have a Workpapers specifically for that, listing out all the things that you're entering into the calculation. For now, we're just going to stick with the standard mileage deduction. Let's click continue. Any other expenses related to the vehicle use, these would actually be separate from the previous calculation. Parking fees, tolls, I'm just going to say no for simplicity right here. So we got the $98. I'm going to click continue. I'm going to click done right here. So here's a summary of our Schedule E. We got our $19,850, which we looked at earlier. We got our $10,593. There's our mileage deduction right there. There is our depreciation. Now, what is the difference between this and what's going to be on Schedule E right now? Right here, this depreciation number is not listed on here. So I'm going to go ahead and put that in, 804, and we're going to end up with a loss. And having a loss on a rental property is actually relatively common, and we'll have to talk about passive activity loss rules and passive losses on rental properties. That's not going to be in this video. It's going to be for another video. All I want to do right now is make sure that this is the number appearing on our Schedule E. So I'm going to go here to the Forms view, and then I'm going to go find Schedule E. Okay, here we are. Here is Schedule E right here. Let me maximize this window. We're looking for a loss of $1,645 at the bottom of this to make sure that we did everything correctly. And there it is. $1,645 loss is being generated from this property in this example. And that loss is going to carry forward depending on, in this situation, remember when we talked about, are you an active participant? Who's going to get that midnight call? That was in the previous video. Who's going to get that midnight call if the toilet is broken? If you are an active participant, you should be able to deduct up to $25,000, I believe it is. So this loss should be deductible on Form 1040. Let's go here and see if it is. Now, the only problem right now is I may not have any other income in the return. I do actually. There's Social Security benefits in here of $48,000. Oh, but they're not taxable because Social Security is only taxable if you have other income causing it to be taxable. If you're interested in learning more about that, I do have videos on Roth IRA conversions, which talk a lot about how Social Security becomes taxable. But that's neither here nor there. The point is, it does carry forward all the way up to the front of your return. Form 1040 right here. That's the rental loss. It doesn't do anything for us now because there is no other income in this particular example return, but you can see that it carries forward to right here. So let's go back and take a look at our tax return supporting Workpapers one more time. I have been talking about this throughout the video series. This is how you get all your ducks in a row. This is how you prepare for a potential audit in the future of your tax return. This is how you have everything organized. And another great benefit to doing this is, a lot of people, they basically do nothing with respect to taxes all year long. And then right before tax time, they get into this mad rush to try to get all their information straight. But things like rental properties, this is going on all year. You can organize this information well in advance, and you can save yourself all the headache and the hassle at tax time by just taking, 15 minutes a month and just getting organized. And so what I have here, this is like the summary page where I have each of my properties listed. But behind the summary page, what I have here is a detail page. So here's the detail page for property 1. So let me just zoom out real quick and show you, like, this is kind of what it looks like high level. And then let's zoom in here so we can see a little bit more of the detail. So basically what we have here is, I guess when I originally set up this example, I didn't start collecting the rent until May, but that's neither here nor there. The concept is the same. So we purchased it in April. We had some expenses relating to like getting it ready for rent. And then we started collecting rent in May, so on and so on. Here's that little refund, some little adjustment that happened in October and so forth. And so if you track these things by month, like this is easy to track by month, it's generally going to be the same for rent. Expenses could vary, but there's not going to often be that many. It could be like you pay your insurance once a year or maybe once every 6 months. Sometimes you incur legal or professional fees, but it's not going to be every month. Maybe you advertise at the beginning of the rental, but you're not going to advertise while it's occupied. You have supplies once in a while. You pay your taxes once a year. This is how you can keep track of everything throughout the year. And what this will do is it'll total it up by month, and then it'll total it up by the by each category for the entire year. And then what happens is these totals are what carry over to the summary work paper and populate the summary for the year. And by setting up a simple work paper like this for yourself, you're able to have all your ducks in a row. You print these off. Like at the end of the year, you would print off this schedule, this supporting schedule. You would print off your summary schedule, and you would have those clipped to the back of your tax return, along with each of the receipts or the credit card statements or whatever it is that supports each of these numbers, something you get from the county about your taxes. And so by doing all of that, that is how you stay organized. Because remember, if an audit happens, it's going to be years from now. And I assure you that when that happens, most people can't find any of this information 3 years later. And so the best time to get organized is when you're doing your taxes, and to get ready for it even throughout the entire year, and then to get all your paperwork clipped together and ready to go right on the back side of your return. Put all of it together. So here, for example, let's say we spent $300 at Zillow. It was on this Amex card. Like, for example, if I printed out my Amex statement, that would be like the first document right here. I could label that document 2023 document 1, 2023 document 2, 2023 document 3. Here's a check to Betsy's Cleaners for something. Here's my insurance for Allstate. Frederick, a lawyer that I paid for something. A Chase Bank statement. Ace Hardware, XYZ County. These are the credit cards that it was on. These are the checks that it was written on. Here is the form that I got from Chase Bank regarding my mortgage interest, and so on. Here are the document references. Here are the printouts. And so what you have is, remember that if you think back to video 1 where we talked about tax return documentation, you have all your source documents. That's the source. Then you have your references right here so you can keep track of everything. Then you have all the relevant information laid out right here. And then it will automatically summarize to right here. Now, I know that some people are going to notice this. They're going to say, wait a second, if I look over here, I have $10,757 of net rental income, but over here we have that loss of $1,645. Remember, that's because the depreciation expense, we calculated that in TurboTax, and I kind of added it in here on the fly. I also added in another $1,500, I believe it was. Yeah, $1,500 for the PMI. And I kind of added that into the summary statement at the last minute. But if we were really building this out properly, what we would do is we would have a line for PMI right here, and we could put that in. We could add our depreciation expense right here would be more appropriate, and then they would all add up. But you see the concept, right? For purposes of the video, I just quickly threw them in here on the summary statement. But the point is, everything should be here. And so this total will ultimately equal this other total. So for example, just to make it completely clear, $10,000 804. So when am I going to incur that? Well, basically at the end of the year. So 10,804 would go right there. And then I added in another 1,500 of the PMI right here. And so that gives me 1,547. I have 1,645. What am I missing? The mileage deduction, which we could also bring over here. Let me just throw that in right here. That's another $98 right there. So if I add these two together, what we got is the 1,645. Okay, so it was just a matter of adding a few things in on the fly as we were preparing the tax return. But at the end of the day, you want to make sure that all of your summary items, or all of your detail items, I should say, match your summary. And that's how you create tax return supporting documentation. Now, another thing that I want to mention for everybody who has purchased the tax planning template and is involved in my course on Roth IRA conversions, if you would like to get these work papers, these are included in your purchase. So just go into the members area and you can download these rental property work papers and you can use them for all of your rental properties. And we have to incorporate a line into the tax planning template for rental property. Let me pull that up. So here is the tax planning template. Rental income is going to be right here in this section. Okay, it's a Schedule 1 item. In fact, let's go look at TurboTax and see that on Schedule 1. Okay, so I'm back in TurboTax. Here was the Form 1040 right there. Here's Schedule 1 under it. Before the rental income or loss makes it from Schedule E up to the 1040, it goes through what's called Schedule 1. And you can see it right here. Rental real estate, there's our minus 1,645 right here. So it's a Schedule 1 item. So for purposes of the tax planning template, it's going to go right here. So if you have business income already set up, remember what I'm trying to do for everybody is I don't want you to have to keep starting over. So most of the updates are going to be like new tabs where you can just move the tab right over into your existing workbook and link it up to this page if necessary. Occasionally, you're just going to have to make a quick update. So what we can do here is I'm just going to insert a row right here. And I'm just going to, in fact, let me undo that because I want the self-employment income to be next to the business income. I'm going to insert a row right here. We can call that rental income. And then we can incorporate that right here. So in this case, I put the minus 1,645 in right there and just make sure that it's summing up in here, which it should if you put the row in the middle. Okay, so that way, once you build out your rental property work papers for your actual tax return, you can then incorporate it into your planner, and then we can start projecting that out into the future for purposes of Roth IRA conversions. If you haven't watched my video series to learn about the tax planning template, just Google or search on YouTube for Number Crunch Nerds Roth IRA conversions, and you can watch the whole video series on that. The point is, I want all of these work papers to eventually link together, or to at a minimum to work together, because we're going to need work papers to support our actual tax returns, and then we're going to need to take that information and we're going to put it into our tax planner and project it out into the future so that we can continue to maximize the benefits of doing our Roth IRA conversions. So again, if you are already in the course, if you have purchased the personal tax planning template, the work papers for the rental property that we just went through have been uploaded to the members area. So you can go in there and you can download this entire workbook here, as well as future workbooks for Schedule C that I'm going to continue to build out and put in there. Like I said, you're going to get access to all updates that I make, and we will continue to make all throughout this month and all throughout 2024 as we continue to plan out our Roth conversions. So that is going to be it for this video, and I will see you in the next one.